Hi, welcome to Money Made Simple. I'm Alpha, and this is my tools tips. Today's topic is on interest, be it credit card interest or mortgage interest. Something that probably the biggest thing that we'll pay in our lives is interest to a financial institution. It can seem a bit sort of overwhelming when you look at the amount of interest that gets paid. So one of my focuses is to try and help you minimize that as much as possible. So I'm going to take you through a couple of calculators and tools that are readily available on the Australian government website. So I'll just share my screen and show you that. It's the Money Smart website. You may already be familiar with it, but it can be a little bit overwhelming because there's so much information on that website, and some of the tools are a little more useful and helpful than others. And there's also terminology there, which might be a bit foreign as well, because of course we never get taught this stuff anywhere. I've ended up doing the Diploma of Financial Planning because I really wanted to know what all this was about. And rather than the sort of quite long journey I've been on to do this, I'd like to just help you fast track that and share things like this. So that's one of the reasons that I've put this video together. So first up, we've got the credit card calculator. So we've got, this is, I'll just get stuck into it. We'll assume about $10,000 as a balance. Obviously, you can fiddle around with that depending on your own personal circumstances. And we'll assume an 18% interest rate. Store cards, that does tend to be higher, so it can be anywhere up to 25, 27%. So you can adjust that to suit your own personal circumstances if you want to actually go and have a play with this yourself. But all you enter in is the balance and the interest rate, and then it'll calculate it for you. So here we have, if you're just paying the minimum repayments each month, it'll take 43 years to pay off. And there'll be a substantial interest component to that. As you can see, it ends up meaning instead of $10,000, you'll pay $36,000. So that's quite a reality check. Obviously, if you pay a higher amount of repayment, so go from $200 a month to $500 almost a month, you can actually adjust that down here. So let's just say $450 is more realistic. So we'll go to $450 and you're paying that every month. You'll pay it off in just over 2 years, which is a lot better. And the interest component will also be a lot smaller. So instead of paying, what's this, $26,000 in interest, you'll only be paying $2,000. So one of the things I do in the Money Made Simple course is go through kind of like a hierarchy of paying off debt, and things with the highest interest rates you pay off as quickly as you possibly can. Get rid of it, get rid of the card, and move on to the next one. And then this is why it can lead to quite a substantial amount, and this will impact your ability to then buy a home and also invest. So you'd much prefer to put that money towards paying off a home or saving for a home deposit, and also being able to invest money, which builds growth, financial growth and wealth, than just like throwing it down the toilet basically to the bank. So that's that one. Then we'll move on to mortgages. So it's amazing how much, I mean, a mortgage is quite a huge amount of money. And then just making some small changes in terms of interest rates and price matching, and either getting your existing financial institution to lower the rate to be competitive, or if they're not willing to do that, just moving elsewhere. Obviously, there are costs involved with changing loans and moving mortgages. So you do need to figure what the benefit will be before you do that. There are some really good low-cost providers out there. When my husband and I bought our home, the loan fee was $300 to actually set up the loan. And then there were no other fees after that. So there was no early repayment fee. There was no other fee, like monthly fees. So it was a really, really simple low cost loan, and the interest rate was very competitive as well. So that's what suits me. I actually had a mortgage broker who offered a loan which you could split, I think, in 10 different ways. You could buy a boat, you could do this, you could do that. It was just way too complicated for me. I just wanted simple, hence Money Made Simple. So let's just assume $500,000 loan current balance. And we'll start with what is at the moment a relatively high interest rate, so 3.5%. Let's assume there's still 20 years remaining on that. And we'll say that the payment frequency is monthly. So the fees, let's say $10 a month. So I will assume that there are some fees here. I'll assume no termination fee for the moment. So let's then look at the new loan. Let's also assume that there's no introductory rate, and that the ongoing rate is going to be 2.4%, which is quite realistic for at the moment. There are quite a few options out there to that amount. Let's just say the $300 application fee, because like I said, that's what I experienced, and that there is no other regular fees, because that's also realistic. And let's have a look. Wow, you can save $65,000 over the life of the loan by reducing by going to a cheaper provider. And if you pay additional repayments, so instead of $2,600 a month, you go to $2,900 a month, so a little over $300, or a little under $300 a month extra, you could actually save $84,000, nearly $85,000 on your loan, which is, you know, almost another 20. So again, paying that off as quickly as you can is by far the best approach, depending on what else you could do with that money. I'm not going to go into that today because there are, especially at the moment where debt is cheap when it comes to these sorts of like mortgages, and investing actually returns quite a lot. You need to actually factor that difference in, but I won't go into that right now. We'll just focus on your mortgage and how much you can save just by switching providers, which is quite a realistic thing to do. And once it's done, you shouldn't have to worry about it again for a while. So amount of effort in the beginning, and then you can set and forget. All right, I do also want to point out the dangers, for want of a better word, of interest-only loans. I've seen this happen a number of times with people I've worked with, and it can be quite destructive. I'll only do it for a year or two while I get back on my feet can sometimes turn into 5, even 10 years. And that can have pretty devastating effects for the amount that you're going to pay on your mortgage. So I'd really caution anyone before they consider an interest-only loan. I realize sometimes it is necessary, but I would try to maneuver any other changes within a household budget before going down this path. But if you do have to go down it, I'll just show you what the impacts can be. So again, we'll look at $500,000 of borrowings. And again, if you want to have a look at Follow Where I Am, the website bar above are the calculators that I'm using. So let's assume 3%. Sometimes your interest rate does actually go up. It may go down, so we'll keep it in between the 2.4 and the 3.5 from the previous calculator. We'll still assume 20 years remaining on the loan life, and let's say 5 years is become the interest-only component. And again, we'll look at a loan that's got $10 a month fees. So you can actually start to see how much extra you end up paying over that 20 years. So here it's saying you'll pay an extra $31,000 in interest on it by having that 5-year period of interest-only payments. And obviously your monthly repayments do increase when you start to pay principal, which is actually drawing down on the value of the loan itself. Interest is just the income that the bank gets. The principal then will remain the same if you're not paying any of that off. So it's very important when you're setting up a loan to make sure you've got principal and interest that you're paying off, not just interest. So yeah, so it's quite a lot. Again, and that's not even taking into account finding a cheaper loan with a lower interest rate, or even trying to find one with no fees as well. So when you think of all of the things you can save, it's compounded one on top of the other. You'll find yourself being more financially independent so much sooner. So that you're not still in debt when you retire, because that's what we're trying to avoid, is getting to that age of 65, 67, or even 70, and still having a home loan debt. So trying to get to the point where that's gone, so that you don't have that hanging over your head in retirement, and preferably paying it off earlier. That would be ideal. That will help you become a lot more financially secure and future-proof your finances. Anyway, I hope you found this useful. You can email me with any questions at support@money-madesimple.com.au.